Whenever the average is near their all-time highs, even if today's pullback, all sorts of people come out of the woodwork to claim that great stocks have become overvalued. But sometimes these stocks have a lot more room to run. Take Capital One Financial, the bank with a huge credit card business that we own for the Charitable Trust, which you can join by, you can follow along by joining the CNBC Investing Club. Now, since we first bought this one for the trust on March 6th, we're already up over 28%, but we're sticking with it. Why? Because I think it's got a tremendous growth story. It's not done anywhere near here. The recent run is all about Capital One's acquisition of Discover Financial in an all-stock deal valued at $35.3 billion. Capital One's always been a major credit card issuer, but buying Discover gives them one of the four major payment networks, right alongside Visa, MasterCard, and American Express. We know all those for your great stocks. What makes Discover even more unique is that, like American Express, it both issues its own cards and processes payments. Visa and MasterCard don't operate that way. They simply collect little tolls for running their own payment networks, and they don't take any credit risk, which is good. In simple terms, this acquisition gives Capital One ownership of the Discover Global Network, allowing them to scale up to become a truly global payments platform. It also helps them reduce the reliance on MasterCard and Visa because now they have a payment network of their own and can collect transaction fees directly. By the way, this is another reason why I was so hostile to the Biden administration's antitrust regulators. They reflexively oppose virtually every merger, but sometimes allowing these deals creates new competition. Discover on its own could never really go toe-to-toe with Visa, MasterCard, or American Express, but Discover combined with Capital One, that's a different story. As the storied CEO Richard Fairbank explains it, quote, "We have always had a belief that the holy grail is to be able to be an issuer with one's own network so that one can deal directly with merchants and from merchants to consumers. It's all part of one comprehensive relationship," end quote. That's huge. But it's not the only reason why I love this acquisition. There's a lot more going on here. For starters, Capital One expects to realize $1.5 billion in cost synergies from this deal in 2027. They see another $1.2 billion in network synergies, partly from lowering payments to third-party credit card providers, partly from shifting Capital One debit and credit card purchase volume away from Visa and MasterCard and onto the Discover network. All told, management believes this deal is going to boost their earnings per share by 15% once we get to 2027. And that is substantial. I mean, this is a bank. You usually don't get that kind of growth. The Discover deal also creates new opportunities for Capital One on the international front. This is something that several bullish analysts have pointed out. Just this past Tuesday, TD Cowen upgraded Capital One, noting, quote, "While Discover as a standalone company had mixed results growing international acceptance of its network, we believe that could be different under COF," end quote. The analyst pointed to Capital One's strong track record of execution and its willingness to invest with a long-term mindset, citing the company's investments in its transaction card franchise and multi-year commitment to better technology. That's something they know a lot better than almost every bank. The Cowen upgrade also highlights another positive aspect of the deal. Capital One may be able to offer more rewards for checking accounts now that they have access to unregulated debit interchange. Basically, Capital One can now earn more money each time a customer swipes their debit card because Discover's network isn't subject to the government fee caps that apply to banks. As a result, these guys can make more money, allowing them to offer debit card rewards, which could help them lure away depositors from competition because most banking competitors can't do this stuff. I know it's little, but these things add up. Most major banks eliminated debit rewards after the implementation of Dodd-Frank Act in 2010. That was an attempt to rein in the industry after the financial crisis. So this one gives Capital One a major advantage. And look, Capital One it's already got great at attracting bigger spenders to its credit cards with an array of enticing perks, everything from cash back and exclusive ticket or reservation access to shopping discounts, and of course travel benefits like TSA PreCheck credits and travel miles bonuses. There's a clear emphasis on travel perks, and one of the most valuable is the airport lounge. Let's face it, nobody can afford to miss their flight, and most of us usually have a lot of time to kill at the gate before we board the plane. And with airlines now boarding what feels like 80% of the plane in Group 7, that wait can feel a lot longer. After this merger, the combined company is the largest credit card company as measured by outstanding customer balances, giving it the scale to invest more heavily in these premium perks, meaning they can run circles around the competition. Sure, those airport lounges are expensive, but Capital One already runs commercials with Taylor Swift, so you know they're not afraid to open up their wallets. All of these synergies and enhanced revenue streams could ultimately lead to additional returns of capital to shareholders as well. And an analysis done by Truist last month estimated that Capital One has $15 billion in excess capital, equivalent to roughly 11% of the company's market cap. While some of that capital will be reinvested in the business, Wells Fargo published a report earlier this month predicting a $7 to $10 billion buyback announcement coming real soon. The banks are lining up in favor of this one. Keep in mind, Capital One's management still plans to complete an internal review of Discover in the second half of the year, which will provide a clearer picture of its capital needs and how much it can ultimately afford to spend on buybacks. Once that happens, though, they might decide to be a very generous buyer of their stock. The Wells Fargo note also expressed optimism that share repurchase could remain elevated, given that Capital One's currently in terrific shape. Delinquencies are trending lower, while the strength in net interest income continues, both positive signs for Capital One's balance sheet and its cash flow. Plus, when it comes to the impact tariffs are having on consumer spending habits, CEO Richard Fairbank noted at a recent conference call, quote, "We just don't see an effect," end quote. Put it all together, and it's easy to see how Capital One stock could keep being rewarded with a higher price-to-earnings multiple. Right now, the stock sells for just 11 times next year's earnings estimates, which makes it incredibly cheap versus American Express at 20 times earnings. I use Amex because it's the closest comparison now that the Discover deal is closed. Visa and MasterCard have even higher multiples. So here's the bottom line on this stock that, even though I know it's about nitty-gritty, but it is very exciting for me. Capital One stock has already had a major run this year, but that's because the Discover acquisition is incredibly positive. So I'm betting the stock has a lot more room to run. Even though the stock's within spitting distance of its all-time high, listen to me. I think it's still way too cheap here at a mere 11 times next year's earnings, and I think it is poised to have multiple years of outstanding growth. Mad Money is back after the break.
Coming up, can investors wrangle a profit out of Contour Brands? Cramer's digging into the apparel company and giving you his take next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.